Hello, this is Dave Lucas from your New York State Association of Counties. We want to welcome our NYSAC members and guests that are listening today for the first session of our virtual NYSAC Legislative Conference. We're going to do a little bit of housekeeping here first, and then we'll get it underway in a couple of minutes. We have 10 separate workshops covering a wide variety of topics this week, and we hope that folks can attend as many as possible. Jeanette, is there anything you need to tell the audience right now?
Yep, just 2 points. We will be recording this session and posting it with a PDF of the slide deck on our website later today. If you would like to submit a question, we ask you to do so in writing via the dashboard. Just click on the questions tab on your dashboard and you can submit it. We will be covering questions at the end of the presentation, and we'll get to as many as possible. And that's it.
Okay, great. So we'll get underway in a moment with the presentation to kick off our conference. But at this time, we want to thank our sponsor for this session, the Alera Group. And Jeanette's going to play a short little video right now.
I'm Eric Lintela with the Alera Group. We're a national employee benefits firm with 7 offices in New York State. I'm in our Rochester office. I've been working with municipalities and public sector employers since 1991 and have worked with NYSAC and its members for a number of years. What I'd like to share with you is the MHFC, the Municipal Healthcare Financing Collective. It's a stop-loss captive that enables municipalities and other public sector employers to pool together in their healthcare benefits. Our 3 initial members have had some very positive results, and so I thought I would share an update with you on those. The first is an upstate county, a smaller county that has saved $570,000 in 2020 as they transitioned into the MHFC. They were able to submit a shared services application for those dollars, so that's a huge win for them. The next is a larger Hudson region county that transferred its Medicare retirees, and in the process we've saved $1 million in premiums without changing benefits, so equal to or better than, and $1 million worth of savings, and that will be annualized. And the third is another capital district county that was able to absorb a high-cost claimant for $1.35 million without a significant rate increase, actually not even more than trend. So the MHFC is enabling counties and municipalities to work together to control healthcare costs and to buy better, buy smarter, and buy cheaper. So we'd love the opportunity to have a discussion, see how we could help you as well. Thank you for your consideration.
Thank you again to the Alera Group for supporting our efforts today to educate hundreds of county officials from across the state. We'd also like to thank Joe Rulison from 3+1 for securing our distinguished speaker today. Morning session, we are going to hear from a top economist about where he thinks our economy is heading over the near term and how long the COVID-induced downturn might last and how that impacts everything we do as county officials. And at this time, I'd like to introduce NYSAC's president, the Honorable Jack Marin of Ontario County, who will be introducing our keynote speaker this morning. Thank you, Jack.
Thank you, Dave, and good morning, everyone. Yes, our special guest speaker today is Vincent Reinhardt, Managing Director, Chief Economist, and Macro Strategist, Bank of New York Mellon. He is responsible for developing views on the global economy and making relative value recommendations across global bond markets, currencies, and sectors. Previously, Vincent served as the chief United States economist and a managing director at Morgan Stanley. For the prior 4 years, he was a resident scholar at the American Enterprise Institute. Vincent also worked in several roles at the Federal Reserve for over 24 years, including director of the Division of Monetary Affairs and Secretary and Economist of the Federal Open Markets Committee, FOMC. His responsibilities at the Federal Reserve included directing research and analysis of monetary policy strategies and the conduct of policy through open market operations, discount window lending, and reserve requirements. Prior to these roles, he was the principal liaison with the domestic desk at the Federal Reserve Bank of New York and was responsible for preparing a document outlining policy alternatives for each FOMC meeting. He was the deputy director in the Division of International Finance and associate economist of the FOMC and spent 5 years at the Federal Reserve Bank of New York in both the domestic and international research departments. His academic publications primarily concern the conduct of policy and issues related to the monetary transmission mechanism, as well as an analysis of alternate auctions techniques in Treasury debt management. After an undergraduate training at Fordham University, he received graduate degrees in economics at Columbia University. This time, it's my pleasure to turn the program over to Vincent Reinhardt.
Thank you for that introduction. You could have gone 4 years back and learned that I also went to high school at Archbishop Molloy in Queens, New York. That's interesting because my classmate for both at Molloy and Fordham was your governor. But let me reassure you, there were both Catholic institutions, so that anything I know about the governor is protected as if it was heard in the confessional. It's actually a good thing for him. I want to remind you that I'm a resource from BNY Mellon Beyond the Next Hour, and I'm going to try not to waste your time during the next hour. I've got 3 goals: to explain the outlook for the US economy, which has to be put in a global frame, to touch on some issues relevant to local economics and public choice, and to emphasize some long-term issues that will resonate for some time to come. And then I hope to turn this into a question, so please do submit questions. However, for those of you who are multitasking at home, I start on page 6 with a summary of what is to come, just in case your attention wanders. Point 1, the successful development of vaccine hastens the herd immunity of the world's population. It makes us more comfortable in participating in market activity because people worried about their health are not fully active participants in the world economy. However, it is going to be an uneven process. That distribution of vaccines will take time across countries and within localities. That exacerbates tensions around the world and within societies and poses a drag on spending, keeping it a while before we regain the prior peak level of output. In our forecast, it doesn't happen until late this year or into 2022. As for health outcomes, I take Fed Chair Jay Powell at his word. It happens late this year and later still for the rest of the world that we reach effective herd immunity. Third, policy impetus is going to offset some of this, but not all of the lingering drag, because central banks are near the limits of their influence, having already put their policy rates as low as they go and expanding their balance sheets mightily. And politics always complicates the effective application of fiscal policy. There will be significant stimulus in the US, making us the best performer of the lot. An issue about that, however, is how much of our stimulus is timely, targeted, and temporary. Fourth, political uncertainties always complicate the outlook, particularly as you have a turn in the administration. Europe is trying to figure out how to bring itself closer together to implement fiscal policy effectively. And the UK is trying to figure out its place in the world. But elections do matter, and in the US context, the two held on January 15th are particularly resonant. And then fifth, inflation's going to move higher, buoyed by tolerance of central banks of above goal outcomes. Central banks will get what they want, more inflation. But the worry is it'll probably more so than they'll be able to handle eventually. But that's not a story about 2021. It's about 2022 and beyond. 5 points have two themes. We're part of the world's economy and policy matters. If we turn to the next slide, let me give you a preview of what's to come. The attractive feature of discussing the outlook for 2021 and beyond is that 2020 is in a rearview mirror. However, its lesson is that the path of the pandemic is central to the economic outlook. My wife Carmen and I, who's a Harvard professor, wrote an article called "The Pandemic Depression" last year for Foreign Affairs magazine. And we made the obvious point at the outset. Pandemics have been scourges for humanity for all its existence. But this is the first time in human history that the world's rich enough to devote material resources to shape its path. That's mitigation efforts. They are about husbanding healthcare resources to buy time. But mitigation efforts impede economic traffic. They keep people as workers away from their jobs. They keep people as consumers away from the marketplace. Because the US is an open economy, it's best to take a high-level view of the progress of the pandemic. That's what I do in the right panels of this chart, plotting both global and US health outcomes in terms of confirmed cases and mortalities. And the reason we have to put it in a global frame is it's not over for us until it's over for everyone. We have open borders. The good news is that we're not at the end, but we are at the beginning of the end of the coronavirus. We don't have an independent health forecast other than that numbers will keep going up unevenly as the world acquires effective herd immunity. The multiple vaccines speed this along and make us a little more confident about that forecast. But the distribution is uneven, and unfortunately, the virus is changeable. People will not return completely to market activity if there's a health risk, and their assessment of health risks will be different almost permanently, even after we have effective herd immunity. Right now, we believe that the world is better at social distancing and contact tracing, better at treatment, and just tired of strict lockdowns. As a result, disruptions to economic activity from COVID-19 have been lessening over time. The big wins are scored early as people return to work in the marketplace, even partially. That's just arithmetic. As the base rises over time, increments to activity add less and less to the growth rate. There's also less frontier to reopen, and the longer it takes, there are more lasting damage accumulating. This dynamic cuts a V in economic activity everywhere. The left panel is about us. It plots an indicator of weekly economic activity, essentially scaled to predict 4-quarter ahead real GDP growth. There are 4 features to the distinct V, which, by the way, is not V for victory. Strict lockdowns cratered economic activity last spring. Partial lifting produced almost equally strong positive growth rates at first, but the growth rate slowed as the level rebounded. That's the point of arithmetic. Importantly, number 4, we're not back to where we started. I didn't add a 5th point that there is a new leg down. That's probably too fine a reading of the data, because this is about the partial lockdowns and the brief fiscal pothole we went through. That is also in the rearview mirror. The V is elsewhere around the world. That's what the right panels are, which looks at indicator of leading activity for our 3 largest trading partners. Notice that China was hit first, hit hard, and came back first. Europe has lagged and flagged in part because of new lockdowns, inconsistent fiscal policy, and uneven vaccine rollout. Beneath the V also is a compositional difference, which I address in the next slide. And the compositional difference is because of the pattern of spending that has different consequences across regions and localities and across income levels. First, about spending. Go back to the original message. Mitigation efforts keep people away from economic activity, as workers from their firms, consumers from their marketplace. Marketplace activity requiring person-to-person interaction was hit particularly hard. That's what you see in the left panel, which plots the 12-month growth of real personal consumer expenditure broken out into its 3 main categories: durable goods, non-durable goods, and services. People did not go out to eat, did not go see a show or game, did not go to school or get on a plane. As a result, at its worst, real spending on services was down almost 20% at mid-year. They did, however, remodel their homes, and durable spending actually increased as much as nearly 10%. And even now, as services have come back some, they're still down on a year-on-year basis, and there's a 17 percentage point difference in the growth rates of spending on services and spending on durable goods. As you see in the table at the upper right, these are big enough changes to change the relative importance of the 3 types of goods and services in our consumption basket. Effectively, households pared 2 percentage points from services and spent them on durables and non-durables. But the important point also to see in that chart is that services make up the lion's share of spending. 67% of spending was directed towards services last year. That sends an important message about what happens to economic activity, or the composition of output, the subject of the next page. In the left panel, I look at the 50 largest economies of the world, comparing the share of industry in their total output along the horizontal axis with real GDP growth last year along the vertical axis. Actually, I really should have said real GDP declines in 2020 on the vertical axis, because note, 45 of the 50 dots are below the 0 axis. Output was contracting just about everywhere. That, by the way, is a very important point to appreciate about our shock. It was synchronous. It affected all economies. We talk about the great financial crisis of 2008 to 2009, which did produce a wrenching recession. But it was a wrenching recession in 11 advanced economies that had complicated financial centers. Actually, emerging market economies grew rather smartly, and commodity prices rose. And that's because China was an engine for their growth. This time round, it was the most synchronous decline in output since the 1930s. Now, what do you note about this? As you move from left to right along the horizontal axis, the share of industry in overall activity increases. And the decline in real GDP last year becomes smaller and smaller. Why? Because goods activity can be conducted more efficiently as social distancing if you don't have the big service sector, if you don't have households that spend a lot on going out and traveling and concerts and conventions, then you were less adversely hit. Note, by the way, that we talk about the Asia Pacific region, particularly China, had a better that dealt better with the pandemic. Part of the reason is their industrial composition made it easier for them to bounce back because those are economies with big manufacturing sectors. If it works for the 50 biggest state economies of the world, then it should also fit for the 50 states of the Union. That's on the right panel. Here is a little different in that I'm using the unemployment rate change in 2020 on the horizontal axis and the share of employment in industry relative to the total. The dots are closer together than in the GDP example, in part because states are more homogeneous, but also importantly, changes in the unemployment rate tend to be smaller than changes in GDP growth, and there's a wedge between employment and GDP. It's called productivity. But anyway, what you see is a negative association between unemployment and industry concentration, or put it the other way, those states with a bigger concentration of manufacturing had a smaller decline in unemployment in 2020. Indeed, the two states where the unemployment rate actually rose last year have a heavy energy component. If you're wondering where New York State is, it's on the line. It has a 24.5% of employed people in New York State or in the industrial sector, and the unemployment rate went up 4.5% or 4.25%, which is typical for the industry composition of your economy. Now, what does this also imply about people? That's the subject of the next exhibit. There's another consequence of the composition, and that is the economic incidence of the pandemic shock was very unfair, hitting lower income households much harder. That is, the pandemic shock is regressive. And I'll start with a puzzle, and that's in the left panel. Why are wages in the service sector higher now, posting such marked gains in 2020 relative to the prior trend? And the answer is about composition. Goods producing workers stayed on the job by and large. High-end service workers stayed on the job because they could perform their tasks at a social distance. But those higher income service workers were doing it from home. They were not going to the office, not buying coffee at the donut shop in the morning or sandwiches at the takeout in the afternoon. They certainly weren't going on business trips or going to conventions. That meant that the lower wage service workers were unemployed. The average hourly wage then goes up because those at the low end of the scale are dropping out. And until you see average hourly earnings in goods producing industries go back to that prior trend, you're going to know that there are still people hurting in terms of the distribution of unemployment. And just to underscore that, look at the table at the right. The bottom three categories, also which are employ almost 45 million U.S. workers, also tend to be the ones that have few lower wages, which is the rightmost column. Notice that the biggest declines in output, rather employment, have been in those sectors that pay low wages. Composition matters, and it really just flows from the disruption to market activity. We do less services that rely on person-to-person contact. Person-to-person contact tends to imply the person on the one side of that transaction is receiving a low wage. Hence, the shock is regressive. Let me also say, as you can see in the next slide, this is not about the cycle. This is about trend. What I've plotted is employment over the whole United States in manufacturing, the red line, and or rather goods producing, the red line, which is almost all manufacturing, and service producing, the blue line. Essentially, since the late 1930s, we've had about 20 million workers in goods producing industries. That hasn't changed. They are increasingly productive, so their share of GDP, their share of total output has been rising, but their share of the overall employment base hasn't changed. We've increasingly become a service economy. That's again why our industrial composition hurt us more than the goods producing intensive economies of the Asia Pacific Rim. It's why large parts of Europe, also concentrated in service producing, are having such a rough spell right now. It also tells you, when you look at this chart, temper your ambition that industrial policy can bend this curve. This is long-standing forces in the global economy. That's why it's a bad shock. That's why we're riding a V. And let me tell you good news and bad news in the next slide. First, the good news. We are riding a V, and we're on the upper leg of that V. Economic rebound. The bad news is rebound is not recovering. We're bouncing back, but we have not recovered the level of output pre-pandemic. You saw that back when I showed you the weekly economic indicator produced by the New York Fed. This takes a higher resolution and looks at, again, real outcomes for the 50 largest economies of the world, in which along the horizontal axis, I plot real GDP growth in 2020. Along the vertical axis, I plot real GDP growth forecasted for 2021. The dashed line that slopes downward in that figure is one in which the outcomes in 2020 are exactly opposite signed what happens in 2021, i.e., the decline in 2020 is perfectly offset by an increase in 2021. So that's the line that tells you which nation income has not changed on net over the 2 years. And the answer is most economies of the world are in the lower left. 3 out of 4 of the economies of the world have output, do not recover the level of output they lost last year, this year, so they end this year at a lower level of output than they ended 2019. What else do you notice about this chart? Again, the synchronous nature of the contraction, because there are only 4 dots to the right of the vertical axis, i.e. economies that didn't contract in 2020. In terms of the composition, the dots that are in the above the axis, i.e. have a higher level of output by the end of this year than at the end of 2019, tend to be emerging markets in the Asian Pacific region. The message is rebound isn't recovery. That we can be growing fast, we can be re-employing people, but we're not back to the level of employment that we started from. Why does that matter? It matters importantly because think of the typical firm or household that decided to take on debt to make commitments at the beginning of 2020. Then the shock came. Those commitments are outsized relative to the amount of resources they actually have rather than what they expected. Moreover, they probably have burned through savings and taken on debt during the declines in activity associated with the lockdowns. That means their balance sheet is weaker now than when they started. The longer it takes to get back to where they started, the weaker their balance sheets become. The more likely people make decisions that distance themselves from continuing in market activity. That is businesses deciding to close, that is debt issuers defaulting, that is workers leaving the workforce, either through retirement or non-market activity. Generally, if you make one of those decisions, it's hard to go back to where you started. So the longer it takes to get from rebound to recovery, the more permanent damage there will be to the economy, the more scarring. And scar tissue stays with us. Now, this has all been pretty negative message. And on the transition slide next, I ask the basic question, and that is, why wasn't it worse? And the answer is policy and policy. Let's start with fiscal support in the US, which has been massive. This is a chart that goes back to 1957. In our lifetimes, there's never been a bigger disconnect between what we as a nation produce and what we as households receive as income. Notice that GDP, the blue, the 4-quarter change in GDP, the blue line, the red line tends to move pretty closely with the 4-quarter change in real disposable income, the blue line. Except last year. In the second quarter of last year, real GDP contracted -9%, worse than the post-war period. But real disposable personal income increased 16.7%. That's a 25 percentage point difference, and that is unprecedented in US experience. And the reason is fiscal support gave more income to households than they produced as workers. That was the stimulus benefits, enhanced unemployment insurance, increased benefits generally. So it wasn't worse because of the massive amount of fiscal support. Now, that line drops off pretty quickly, and the speed of that descent is part of the reason, and the narrowing of that difference is part of the reason we slowed entering the 4th quarter of last year into this year. But they're going to open up again, given the passage of already past $900 billion stimulus package, and the high likelihood we'll get something on the order of $1.9 trillion more in stimulus. This, by the way, supports my model, core model of the political economy. Washington, D.C. is mostly dysfunctional, and politicians only cooperate if forced by big events. the economic free fall in the spring was such an event, and we got three big pieces of legislation in about as many weeks in March. But then that's how we got the enormous spike or wedge between disposable personal income and GDP. But as we began to see the effects of that support, i.e. the beginning of the rebound, politicians mistook that for recovery and eased off the pedal. Seeing the consequences of that for activity, we're going to get some more stimulus. That has medium and longer term consequences, but maybe we'll get to address that in the questions parts. By the way, this isn't just a US phenomenon. In the next panel, I show the outcomes in 2020 for advanced economies. That would be on page 17. What I plotted here is a picture of the cyclically adjusted budget balance as a share of GDP for advanced economies. In 2019 along the horizontal axis, and in 2020 along the vertical axis. And the red line does the same counting exercise. It tells you the combinations in which the budget balance would have been the same in 2019 and in 2020. And the answer is every single advanced economy is below that red line of unchanged budget, counter-cyclical budget deficit. Everybody expanded their cyclically adjusted budget balance, and in some cases massively, as in the high teens worth of nominal disposable income, including economies that already started from a base of relatively big budget deficits. If you want to position the U.S. in the scheme in this cloud of dots, we're toward the lower left. We started with a relatively large deficit, and we've added to it because of the waves of fiscal stimulus. And if we extend this to 2021 with the likely passage of a $1.9 trillion additional stimulus, that dot's going to dip further and further below the axis. Let me say, though, when you think about the effects of the existing stimulus and evaluate the likely stimulus to come, you have to appreciate the economic effects are complicated, and that's what's addressed in the next slide, page 18. What I plot at the left is the personal saving rate, which for the last few decades, you could say it averages about 7% of worth of disposable personal income. When those stimulus checks were cut in the spring of last year, when unemployment benefits kicked up, a lot of it was saved. The personal saving rate went to a post-war record of essentially 1/3. Households were saving 1/3 of their disposable personal income. And it tracked above that 7% horizontal norm for the rest of the year. And so I do the tallying in the table at the right and just ask the question, well, suppose since the start of the pandemic, households had saved what they usually did, about 7% of GDP. How much excess saving relative to normal will they have accumulated? And the answer is, if you save for a couple months, 1/3 to 1/4 of your income, it does accumulate. And since the line everywhere tracks well above 7%, you see at the bottom right cumulative sum, households have accumulated about $1.5 trillion of extra saving in the form of stimulus that was unspent. So this is another one of those cases where an economist will tell you that's good news and there's bad news. The good news is households do have more wherewithal to ride out this shock. That's the excess savings. But it also tells you that the multiplier effects of the stimulus we've already gotten were lessened because a lot of it was diverted to saving. As you think about additional fiscal stimulus, you've got to weigh the benefits of strengthening household and state and localities' balance sheets against the lack of follow through for that stimulus. Were those dollars well spent? Speaking of state and localities, I just look at some national data on the next slide. That's page 19. Again, the composition of production, the regressive nature of the shock, and federal support actually help states and localities. From a budget perspective, there's good news that an adverse shock is regressive because it doesn't necessarily hurt as badly your budget prospects. The fact that high wage workers remained in work and therefore paying current taxes and spending on services meant you see in the second and third line that there isn't a marked decline in personal current taxes or sales taxes. Moreover, as you see in the seventh line, federal grants and aid produced that enormous Q2 spike associated with the CARES Act. A consequence of that is, in fact, despite all the worries at the beginning of the pandemic, states and localities have through the combination of budget support and the uneven incidence of the shock, done better than expected. Meanwhile, so we've got support at the federal level, we have a functioning states and localities, and as in the next slide, central bank policy remains extraordinarily accommodative. I do it for the big three in this chart, looking at the net increases in their central bank balance sheets of the European Central Bank, the Bank of Japan, and the Federal Reserve at the left, and what they've done with their policy rate at the right. And the answer is the Federal Reserve is first in the pack with a balance sheet that's 8 times bigger than when all the talk of unconventional policy started before the great financial crisis. That the leg up J-PAL engineered last spring took basically doubled the balance sheet to what's not shown there to about $7.5 trillion. And meanwhile, they've put the policy rate at 0. By the way, in the previous chart, that's another benefit to states and localities. Interest expense is quite low. Just as an aside, relative to their colleague central banks, the Federal Reserve stopped at 0. Both the Bank of Japan and the European Central Bank actually have negative policy rates. What's that mean? They actually tax their banks for the privilege of holding reserves. By buying securities, they've created more reserves, and then they tax banks for holding those reserves. The Federal Reserve stopped at 0 because they don't think policymakers there do not think a negative policy rate is effective. That attacks on banks don't make sense at a time where you want banks to support economic activity, where you want them to lend. Moreover, we have a very competitive banking system and competition to banks, namely money market mutual funds and other short-term investment alternatives. And so banks could be seriously disintermediated if you tax them. Doesn't mean the Federal Reserve won't ever go negative, but they would have to be hard pressed to do so. As we turn to the next slide, as with other central banks, the Federal Reserve embraces overshooting and really has, you should think about it as operating with interest rates with a macro intent and then operating with the balance sheet. The Fed is promising to get inflation above 2%, starting from below, even though right now we have resource slack. The plan is to say it often enough to convince people inflation will rise so that inflation rises. It basically, there's a core expectational element to the determination of inflation. And if you can get people convinced the central bank will generate inflation, then they'll come to expect inflation, and it will make it easier for the Federal Reserve to generate inflation. And Fed communication right now is designed to avoid investors expecting that accommodation will be removed too soon. So Federal Reserve Chair Jay Powell testifies in the semi-annual report testimony on monetary policy, otherwise known as the Humphrey Hawkins testimony, tomorrow and Wednesday. Expect him to say over and over and over again, I'm not even thinking about raising rates. For him, the best way to get inflation to overshoot is to convince investors there will not be a premature withdrawal of policy stimulus. Now, the balance sheet actions initially were taken to support market functioning. If market makers are uncertain about transacting, the Fed can make its balance sheet big, and it did. And so it was supporting the Treasury market and private through balance sheet actions. It prevented the fire sale of assets by showing a willingness to lend to non-depository institutions. That's the Main Street lending program. It's the program where they're willing to buy investment grade debt. The promise was enough. They didn't actually have to buy a lot of it. They didn't have to lend much against those sorts of credit risk instruments as collateral, but the promise to do so prevented even worse fire sales of assets. And then lastly, they want to provide macro policy impetus by making the balance sheet bigger and bigger. And indeed, in some sense, the willingness to make their balance sheet bigger and bigger underscores their desire to keep interest rates low for a long time. The Fed is uniform in its message. So that's why, as in the next slide, the Fed will probably be successful in generating inflation, but it should be careful about what it wishes for. Inflation has been pretty stable essentially this century, back to where we were in the first part of the 1960s. But the first part of the 1960s were followed by the second part of the 1960s, where the Federal Reserve was too tied to the US Treasury, and monetary policy was dominated by fiscal policy. It is good to have the Fed and the Treasury working together at a time of duress. The issue is, can the Fed exit that embrace if it has to raise rates in a hurry? And that's an open issue. Investors, as you see in the next slide, believe the story that the Fed will get inflation above 2, but they seem increasingly worried that they'll do more than that. What this chart does is look at inflation compensation from the Treasury market. It compares Treasury nominal yields to indexed or real yields, and the difference is inflation compensation. At the worst of the spring of last year, investors were worried about deflation. They didn't think the Fed would get close to goal. Now those worries have subsided, and they do suggest the Fed will be successful in getting inflation to rise. A risk, as in the next slides, is the situation could get unruly if the US dollar were to weaken significantly more and commodity prices rise further. That downward slope in the red and blue lines tell you the dollar has been depreciating in currency markets. The upward leg to the price of WTI oil tells you oil prices are rising. That's a risk to the Fed's longer term commitment to price stability. Now, one last caution about monetary policy in the next slide is that to his credit, Federal Reserve Chair Jay Powell has continued the outreach that Janet Yellen started to underserved parts of our population. She started, and he has been emphasizing that the Fed should care about unemployment rates by group, and that the Fed's job's not done until unemployment rate by Black and Hispanic and Latinos is improved significantly from where it is. It's complicated when you talk about inequality and monetary policy because the Fed doesn't have the right tool for that. You see in the left panel that the unemployment rates of the underserved have a much higher cyclical amplitude. When the unemployment rate for whites go up, it more than doubles for Latinos and it triples for Black or African American. That's been a feature of our business cycle since as long as the Bureau of Labor Statistic has been attributing workers according to race or ethnicity. Therefore, as Janet Yellen pioneered, really, if you run the labor market hot, you will disproportionately benefit the underserved. And that is why the Federal Reserve took great pride just before the pandemic that unemployment rates were historically low for underserved parts of our society. That cyclical amplitude works to the advantage of the underserved if you're willing to run the labor market hot. That's Fed policy. But Fed policy works through markets. You keep rates low and you encourage wealth creation. You support equity price gains. You make it more attractive to issue debt. And what you see is that the Fed's policies, as in the upper right panel, have been associated with a V-shaped in the wealth to income ratio. That is the green line measured along the left axis. That's not a bug, that is a feature of the monetary transmission mechanism. The Fed works through markets to provide support to the economy generally. However, the consequence of that is that incomes is earned unequally and wealth is held even more unequally. See in the bottom panel that looks at median wealth by age and group, that for over 55, American households headed by somebody over 55 have a median of about $315,000 for white families. For Black families, it's a sixth of that. For Hispanics, it's a third of that. The discrepancy is worse the younger and younger households get. So here's the problem. The Federal Reserve can run policy hot, keep interest rates low, and help income outcomes, i.e. unemployment. But it makes worse the inequality of the distribution of wealth. And that is Jay Powell's dilemma. Since I've already spoken for 45 minutes and do want to get to your questions, let's see if you've got any questions.
Well, thank you, Vincent. This is Dave. Hopefully folks can hear me. Can you hear me, Vincent?
Yes, I can.
All right, great. Couple of questions have
And-
come in related to the national debt. So is this going to be a problem in the future, especially if interest rates rise?
Absolutely. So the gross debt, the public debt relative to the nominal GDP is over 100%. Last time it was that high was in 1946. In some sense, I think the story is pretty straightforward. We were fighting a war against the coronavirus. When you're fighting a war, you don't worry about deficits and debt. You worry about winning the war. You can worry about them after the war's over. The problem with that analogy is after the last big spikes in debt to GDP, after the War of 1812, after the Great War, after World War II, the government really wanted to get back to surpluses, and they could do so in a hurry because they demobilized workers. Moreover, there was a lot of technological innovations associated with fighting wars that made their workers coming back to the workforce more productive. And so it was easy to make the turn from deficit to surplus. This time round, it's not the case because there's a more permanent aspect to the ratcheting up of health spending and the way we will operate going forward as a consequence of the pandemic. That means that our budget prospects are impaired. My wife Carmen and Ken Rogoff and I wrote a couple papers where we looked at the experience since the Napoleonic War of 26 advanced economies with regard to debt and growth. What we found is when economies have very high debt loads, they tend to grow slower than their own experience. It's part because they've crowded out private investment. They're not resilient to take advantage of other opportunities when the time comes or adverse shocks. And they resort to other means to finance, including financial repression, which tends to hurt growth. So the concern we should have is not that we spent a lot to deal with the pandemic, is that we made sure that the uses of those funds were timely, targeted, and temporary. So it doesn't, we don't take a temporary event and permanently change the course of the deficit.
Thank you. There's another question here. It really kind of bring it back to county budgeting issues. And I know you've spent time in New York, but from a county perspective, we have two primary sources of revenue. We have property tax and sales tax. And you had a chart on that for a nationwide issue. But I think the question here is, given the future projections of economic growth in the United States for 2021 and 2022, what would be your recommendation for counties in setting up their calendar year 2022 budgets? Should they be budgeting for a loss in sales tax revenue and property tax revenue?
So I think the answer is much clearer for the former than the latter. For the former, we're in rebound mode. We will be getting to recovery. We are throwing an enormous amount of federal stimulus at the problem. And so we will be growing above trend this year and into next. There are issues further down the road, if you were doing long-term planning with regard to how the Fed extricates itself from all its policy accommodation and what happens when interest rates rise and interest service costs balloon. But that's not about 2021 and 2022. This year and next, the US economy will be growing above trend. Then think back about the important message of the composition of activity on overall outlook, output and incomes. What has to come back more than anything is services, and so therefore a service-centric economy like New York State will will be growing not only just above trend, but probably above national trend. Much harder on property taxes, and that's simply what lessons, when this is over, will people take about where to locate activity, where to live. There have been people forecasting the death of cities forever, people forecasting the flight from Northeast states to the Southeast forever. Some of it's true. And I think there will be a question of how large city centers operate with increased social distancing. I think there will be a question that chances are most CEOs in the private sector like the fact they're not spending a lot on the travel budget and have the opportunity to cut their real estate budget in terms of office space. And so that does suggest there will be problems in the places more heavily concentrated toward entertainment and lodging, and where activity is the most concentrated. But that does suggest, therefore, there'll be benefits for those people in the suburbs and exurbs. So property tax, harder to say. I would think city centers will probably do worse than the national average, but the Federal Reserve is supporting activity such that the national average will do pretty well. That's the issue of financial stability, really.
Thank you. Yeah, I think we've seen it in New York City. We've seen some data on the property tax trends there, and clearly they're very reliant on property taxes in the large office buildings, and they're projecting an almost 10% drop in property tax collections going into next year. So it is a tougher one to measure, right? And hopefully I listened to your question and answered and understood it. There's a question here that says, is 2022 going to be a recovery year or a growth year? I think you basically said it's going to be a growth year.
Yep. By the beginning of 2022, we should recover the level of output we had at the end of 2019, and it will be about getting back to the prior trend. And so we should have an above from below. That is, we'll have an above trend growth in 2022. Not as fast as 2021 because presumably fiscal impetus will wane because it's no longer needed, and we begin to address the issue of how to deal with the deficit.
Okay. Your national charts show that property tax revenues and sales tax revenues for municipalities have remained relatively steady through the pandemic, and expenditures have likewise remained flat. Given that, what do you think municipalities will do with this additional stimulus that's in this next 1.9 trillion? There's a 350 billion set aside for state and local government. Where do you think it would be best to target that, or how do you think they will?
So, unfortunately, you have to consider the strategic game between states and localities and the federal government. Would think that it is the ambition of the Biden administration to spend some more, namely on infrastructure spending, particularly if it has a green tint. I wouldn't necessarily then play that game and say we don't want to do it now because we want those budget dollars later in the year, because later in the year might not happen. And so I think the answer is where there is the most pressing need, and the most pressing need for lots of places are infrastructure. And recognizing those projects take a long time, and view this as seed money for things that maybe the federal government would be willing to fund later on.
All right, you've kind of mentioned this before. This is a question for me actually about employment levels, and it's very uneven across the states. Certain parts of the states are lagging, and noticeably New York City for a lot of reasons. Do you have an idea of when the national economy or the employment levels will be back to where they were pre-pandemic? And specifically, how do you think that will be in New York State? Will be behind the tail
Yeah,
or?
yeah. So I think there is good news and bad news. Let me work back from the bad news. It is possible there will be longer lasting structural changes as a result of the pandemic. I don't think that, particularly at the corporate level, travel and entertaining and convention going will be as intense as it was in 2019, because people have learned that you can conduct business with Zoom, with WebEx, with GoToMeeting, and as a consequence, there are cost savings that businesses will take. Those cost savings are incomes not generated typically by lower income service workers in big city centers. So that part could be structural. As for the cycle part of it, the cycle is definitely pretty robust. We will grow above trend in 2021 and in 2022. The fact that services had come down so much gives it more opportunity to bounce back. So I would think that New York State will grow above trend. But if you're thinking about the medium and longer term, there are going to be some regions that are are not going to be as attractive places to work and live as they had been.
Okay, there's another question that just came in. Do you think the new and different policy direction of the Biden administration will adversely affect getting back to the beginning as you previously suggested?
So I think that, look, boy, that's a very complicated question that's difficult to unpack. And the reason is that governments are complicated and we can talk at two levels. And the one is as a discretionary fiscal authority, the Biden administration is going big and is going to do as many things possible to get us back toward trend as quickly as possible. So in that sense, the change in administration means there will be more fiscal support. There will be more pressure on the Federal Reserve to keep policy accommodative. That will be on net associated with a stronger cyclical rebound in the U.S. economy. That said, there are two sets of policies where the Biden administration might be impeding longer term growth, and that is re-regulation, to the extent that the pendulum of regulation always swings, and it always swings too far. And so I think the risk is there may be there are just so many different climate SARs in the administration. I think it does suggest a possibility that will go too fast in re-regulating. And the other is what we talked about previously, and that is the accumulation of debt. If you're a more aggressive fiscal discretionary fiscal policymaker, you accumulate debt faster, and ultimately you need a plan that convincingly establishes you not continue to rely on large-scale deficit spending. That's a particular problem in the U.S., by the way, because we rely on the kindness of strangers. We're running budget deficits and we're running current account deficits, i.e., it's foreigners who are buying an increasing fraction of our treasury debt.
Okay, we're getting near the end here, but there's could you explain again why you call the recent economic shock regressive?
Yeah, regressive just means that it hits people with lower incomes harder than those with upper incomes. And because lower income people tend to be in more basically service-oriented jobs that involve person-to-person contact, they got hit hardest. They are the ones more likely to lose their job. It's regressive also because lower income households and nations tend to have fewer resources to tide them over. So regressive just means unfortunate, and the synonyms would be cruel, right? That regressive means that it affects those with less wherewithal harder.
Okay. And I think this will be the last question, so to wrap today. How much do you think the new stimulus package, if it gets signed into law, this 1.9 trillion, how much impact do you think that'll have on New York State?
So big, as already noted, $350 billion in direct aid to states and localities. I think that would be among other things, opportunities to shore up the MTA. It would probably mean you have to rely less on future income taxes, and it makes it even more likely that New York has an above trend rebound into recovery. The danger in all this is to scale up activities when the federal government is providing those resources, only to find that they have a continued state obligation when the federal government stops providing those resources. So you got to figure out how to use it in a way that doesn't permanently ramp up the level of government activity, because at some future date, you may have a House, Senate, and White House that is less generous.
So view it as one-time money for a one-time purpose.
Exactly.
Yeah. I think that's it we have for questions. I think we're out of time right now. So thank you so much, Vincent, for your time today. And as we said before, we will post a presentation on our website. And again, I want to thank Alera Group one more time for sponsoring this webinar, and I'll turn it back over to Jeanette. I think we're done then with this webinar. And
all right. Thank you for thinking about me.